Hello, everyone. Thank you for joining us today for this conversation on debunking common misconceptions around ESG investing. Today, I'm happy to share that we'll be talking about the myth around ESG investing. My name is Sorel Gachu, and I'm the Community Engagement Manager for Intentional Endowments Network, and I'm excited to welcome you for this conversation. This conversation will be in partnership with Ethic and As You Sow. For those unfamiliar with our network, we are a peer learning network that advances intentional design endowments through resources, education, and discussions like this one. Our member includes over 200 endowments, asset owners, and service providers. A few quick housekeeping before we get started on this conversation are, this session will be recorded throughout. You will be muted, so you won't be able to speak. And you can add your comments, questions for the panelists in the comment section or the Q&A features. Today, this conversation will clarify the myth around ESG investing, and by the end, you will have actionable insights to communicate this belief of sustainable investing effectively. Now, we will dive in, and I will turn it over to Claire, who is the lead relationship manager for institutions at Ethics. Without further ado, I will turn it to you, Claire. Thank you.
Wonderful. Thank you, Sorel. And thank you to everybody for joining us today. We're super excited to host our first webinar with IEN. We've been a part of the group for probably 2 years now. Time flies, but it's been such a pleasure to get to know everybody and attend as many events as possible. But yeah, today we are partnering with our friends over at As You Sow, and we thought it could be interesting to have a bit of a discussion around some of the more pervasive myths or misconceptions that we might hear surrounding the industry that we all work in. And we're just going to kind of go through these super organically, have a discussion here. We received some questions ahead of time from the folks at IEN. Feel free to add additional questions, and we can kind of chat through these as they come up. To kick off, I'll give a bit of background on Ethic and myself, and then I'll kick it over to Andy and Kellen to share some background as well. First off, I will just state from our friends at Compliance that everything that we're chatting through today, we are not speaking on behalf of Ethic. These are our own opinions, myself and Kellen, but super excited to chat through some of these topics with the group here. So I'll kick off with some background on Ethic. Like Sorel mentioned, my name is Claire. I am a relationship manager on our institutions team here at Ethic. So I've been with the firm for 5 years, working with our compliance in a variety of capacities. Today, I work with our institutional clients, so mainly foundations, endowments, families, and we help our clients think about how they can have impact with their investments, review their existing portfolios, and align their future investments with the causes that they care about. So some background on Ethic. We are a technology-driven asset manager, and we are focused entirely on sustainability. So we create portfolios that are personalized to our clients, personalized to their sustainability values and goals, as well as their financial profiles. Today, we're mostly focused on equity solutions, and we have been historically, but we're doing a bit more work in the multi-asset space as well. We manage over $6 billion in assets across thousands of accounts, and we partner with OCIOs, investment consultants, multifamily offices, advisory firms, again, to help their clients align their investments with their values. A few things that are unique about us as a firm is really our approach to sustainability, which we'll chat through quite a bit today, how we leverage technology for scale and the client experience that we build around that to be able to really equip our partners to have these more complex sustainability discussions with their clients and the individuals that they serve. So I will kick it over maybe to Kellen to give a quick background on your role at Ethic, and then over to Andy as well.
Thanks, Claire. So I sit on the sustainability team, and I look over our sustainability data model and our insights. As Claire mentioned, we have a bit of a different structure over here. I started my career off in the environmental nonprofit space. I also worked more in traditional risk management and startups across like carbon accounting, et cetera, et cetera. Been at Ethic for about 4 years. Super excited to chat through today.
And I'm Andy Behar. I run a nonprofit. It's a 501c3 called As You Sow. We've been around since 1992. So 32 years working on corporate accountability through the lens of shareholders. We engage many, many companies every year. We write original reports, do a great deal of research. We're probably best known for filing a great number of shareholder resolutions, which is a result of escalation in these engagements, and essentially working on trying to help corporations to reduce material risk to all stakeholders and to achieve long-term sustainability goals.
Wonderful. Well, thank you both. So I think we should dive in. Let's do some myth busting. We thought about getting creative with playing the theme song from the show, if anybody recalls, but we didn't quite get there. So we'll have to use our imagination throughout the conversation today. But the first one that I thought we could kick off with is just this idea that ESG is a one-size-fits-all framework. I put that term in finger quotes because, as we all kind of know, there's a lot of industry jargon terminology and ways that folks kind of refer to what we're really trying to do here. So you might have heard sustainable investing, values-aligned investing, ESG investing. But I thought quickly we could kind of just speak to that idea, that really limited idea that ESG is a one-size-fits-all framework. Kellen, Andy, whoever wants to jump in first, go ahead.
I'll start. I mean, the acronym environmental, social, and governance, or the acronym for environmental, social, and governance, is just shorthand for we assess risk. We assess environmental risk. We assess social risk. We assess governance risk. We assess and address risk, which means all investing is essentially addressing risk. If you don't address risk in your investing, if you don't address risk as a business, you're not going to be in business for very long. So, I mean, the fact that it's been politicized, that a great deal of money has been given to a small group to create an anti-ESG crusade, to say we are against assessing risk. It's the equivalent of that movie, Don't Look Up. It's don't look at the risk. And that's essentially what the oil companies, in this age of climate change, don't want you to look at the risk of oil. Private prisons don't want you to look at the risk of systemic racism. So this is what it's about, is as an investor, as a business owner, are you going to assess and address risk, or are you going to ignore risk? And the fact that they've gotten a couple of states to make assessing and addressing risk illegal is actually a breach of their fiduciary duty. So you get into that kind of contradiction. So I think, just to debunk the myth that ESG is something that everyone has been doing since the history of, the ancient Greeks used ESG. They assessed and addressed risk when they were sending ships out to sea on trade routes. Farmers, since 10,000 years, have been assessing and addressing weather risk. So this is nothing new. It's just a matter of it's politicized.
Yep. Yep.
Yeah, I think it's very well said. I also just would say, like, sustainability is so complex, right? And as Andy was saying, this has been integrated into investing for a very, very long time. It just shows up in different places. Sometimes it's explicitly called out on a 10K. Sometimes it's just one of the driving factors behind this. I think we saw this in the pandemic with supply chain dependencies, and we've certainly seen it with extreme weather much more recently, increasingly recently. I think one of the things that's also important is jargon, as you mentioned, Claire, and some of these acronyms are easy to misuse and over applied. ESG refers to a bunch of different strategies, even if it's in this more intentionally applied space. And sometimes people think that means it's the same across all geographies, across all industries. There's so many different thematics you could run or targeted strategies. And so I think it's just good to remember that this is an umbrella term that I think, as Andy mentioned, is not necessarily distinct from investing. It's just another way of highlighting the risks that you should especially focus on and that traditionally have been left out potentially.
Yep. And I think one thing that I thought we could maybe quickly touch on is this idea of perhaps the misuse of that term ESG. Oftentimes in what we think of as greenwashing, a lot of times in terms of how we're naming a lot of these funds and strategies that folks are offering to their investors. Something that we have seen become a lot more prevalent over the last couple of years in terms of the regulatory environment. We're seeing the SEC really kind of crack down on some firms as of late and holding them more accountable. So maybe we can quickly touch on that piece as well for the folks here.
Yeah, well, the terminology has definitely been misused. I mean, you look at something like the BlackRock LifePath ESG fund. It is not an ESG fund. It's got 331 oil companies, and it was oddly banned by Texas for being because it has the letters in the name, but they're not looking at the actual holdings. It actually has more Texas oil in it than anything. If anything, they should be pushing for that. And so the SEC came out with a new fund naming rule. It took many years. We actually, we did a lot of work with the SEC to help them analyze. We have a platform called Invest Your Values, and you can go to it at investyourvalues.org. And what we do is every month we update 6,000 mutual funds, and we look at what's inside them. Because most people don't have a clue even what a mutual fund is, what an ETF is, that it's a basket of stocks, but they don't know what stocks are inside there. So we show them, here's a list of all the fossil fuel companies, all the deforestation companies, all the private prisons, it's just very, very simple in terms of it's a labeling platform.
Right.
Here's what's inside the jar. And what we found is that out of 90 funds that had ESG in their name, 60 got a D or an F from us on ESG. And so we did this whole analysis, and well, the SEC fund naming rule came out, and basically what it says is the name has to reflect what's held in the fund, which has to be reflected in the prospectus. Our analysis, which we worked on with the University of San Diego, their conclusion was you could not tell from reading a prospectus whether a fund was going to get an A or an F, but there was no connection between the two. And the FCA in the UK also has just come out with sustainability definitions for all their funds. CSRD is going to have a great deal that's in Europe, is going to really impact this. So I think we're at the threshold of a new era in sustainable investing, where the folks who are doing the investing are going to have much better information to be able to make those decisions. And a lot of that misleading information that, frankly, marketing teams at these big asset managers were using because they could, that's going to be shifting away. And that's going to be really helpful for everybody.
Right. Yep.
Yeah, I think we see some of the same with, funds that are labeled fossil fuel free, or this idea of zero tolerance. And then, you really look at it, and a lot of ETFs have the ability to use 20% in a pretty discretionary manner. And so they'll end up with all these different types of holdings. And I think in a similar way, a lot of the work we do is walking clients through what's already in their portfolio and how this may actually not line up with their values, being able to showcase, I think, as Andy said, some of the surprising ways that companies can get in there. And I agree, like, we're super excited to see more, I think, sophistication in how people are evaluating this, and also some regulation that is really going to level the playing field and allow folks that are actually directed to this to showcase what they're doing. I think it's always super important to understand the process of what's going into the strategy.
Yeah, it's a little, I mean, it's kind of shocking when people realize that 100 million people with $10 trillion have no idea what they're invested in. And what the fact is that they're all invested in the extractive economy, the current status quo. People say, why isn't the world changing? Why aren't we moving more rapidly towards sustainability and justice? Well, it's because you're profiting from unsustainability and injustice. And, we point out that, for instance, on private prisons, which are really it's really a proxy for racial injustice. You go into a courtroom, everyone in the courtroom is going to make money. They all are going to profit from finding a person guilty and putting them in a private prison. There's this, but people are not even aware of it. So it's working at a very subconscious level. That's why we feel so stuck. But I think people are waking up. I know that a lot of the big companies are looking at their 401k plans. 1,000 Googlers just signed a petition saying we want sustainable funds. We want to invest in a livable planet in the future. We want to invest in a planet we can actually retire on. And I think more and more people are getting aware of it. And I think, a lot of the work that you've done at Ethic, and also, I mean, frankly, there's there's so many people who've been for the last 30, 40 years have been doing great work to actually create good products that are, that are sustainable and, haven't been taking advantage of that naming rule. They just, so I think it's time that we actually just got more serious about real transparency.
Yep.
Yeah, and I just one of the things that we think is along those lines is, like you said, the complexity or the ways that involvement can work in indirect or secondary or like tertiary effects, or fossil fuel financing or fossil fuel insurance, or there's so many different ways, or even marketing. There's some interesting groups that are pushing some of the creative agencies to reevaluate which clients they work with, and I think those things are really important for people to think about. It's not just one thing necessarily, it is a structure. And this is not just for fossil fuel involvement. Obviously, like you could look at the extractive operations, but it's for a lot of different things that are a focus. I think there's that underlying complexity it's good to represent.
That's great. And I think this is perhaps a good segue, because a lot of the things that we just touched on are really informed by the data that we have around companies, around private person involvement, destruction industry. So one of the myths that we wanted to chat through today was this idea that sustainability data is low quality, or perhaps not as good as it needs to be able to make informed decisions about the companies that we're investing in. So maybe we can transition here to just unpack that idea that sustainability data is low quality, not necessarily something that we agree with here at Ethic. We think it's quite good. But yeah, let's maybe touch on that piece, and we can weave in some questions that we got from the audience related to sustainability data as well.
Yeah, I mean, I think the bottom line is there is good data out there, but that there's also really bad data. That a lot of right now, a company can disclose misleading information and there's no penalty for it. So let's just say, your carbon emissions. So companies can literally put out completely misleading data. It gets scraped up into these databases, and now it's in a database. So people go, oh yeah, it's in MSCI, it's in Sustainalytics. So therefore it must be true. It's not the case. They scrape bad data, garbage in, garbage out. But there is great data out there. And I got to say, a lot of it is generated by nonprofits like us, because we have actual human beings who are talking to the companies, who are giving companies surveys, who are analyzing the data. If we do scrape it, we are double checking it and making sure it makes sense. And we've actually, and I got to just throw in a little pitch here, we've actually spun off a for-profit enterprise called As You Know, which is aggregating all of our data and data from other nonprofits into a database of high quality ESG data. And we're licensing it into the commercial marketplace. And then the license fees are then distributed back down to the nonprofits so that we can all maintain our data. Because one of the hardest things as a nonprofit is, you can get a grant to create the key performance indicators, to write that report, but then it goes stale and you want to be able to update it. Right now, we update our racial justice and DEI data on 3,000 companies every quarter. And the reason we do that is because it's licensed for folks who are using it in their portfolios or for analysis. And that money goes right to researchers to maintain the data. So I think that this is an evolution that we're trying to build. And when people start to use data generated by nonprofits, and then the data can be then maintained, the coverage can be expanded, the data gets better, it starts to create a very positive cycle. And that's part of what we're doing. But there is a lot of misleading and bad data out there.
Yeah, that was exactly what I was gonna say, is that it's really thinking about the purpose, right? Like I think you wouldn't do that in more of a traditional, taking traditional financial metrics if you don't understand what's behind a metric, or you haven't compared it to the peers, or you haven't looked into the way the company's preparing it. You wouldn't just go and run with that data necessarily. I think it's similar for sustainability, where it's really important to think, okay, is this policy variable really what I want? Is it something that the company can manipulate essentially? Is it greenwashing? What am I really looking at here? And I think, as Andy said, there's some tremendous work that we integrate a lot of in our model from nonprofits, from whistleblowers, some of the real subject matter experts that are looking at this and providing a check. We think it's also important to take some of these quantitative metrics from the companies themselves, but we do a lot of quality assurance on top of that. We use our own estimation to see if this is reasonable. We do checks on the actual scope. There's interesting things coming in play right now with AI and the energy and carbon emissions that are being used from that, and how companies report that into, their traditional like scope 1, 2, and 3, as defined by the greenhouse gas, the GHG protocol. So I think it's really important to think about the context of what you want. How do I know this is true? And what are the best indicators? Like what's really priority? What is the hardest to manipulate? And then also what gets to the heart of what I'm really trying to evaluate or focus on.
Yeah, Kellen, maybe you can drill in a bit on that idea of estimation, because that's a question that I oftentimes get from our clients. They want to understand, what do we do in a scenario when certain companies aren't reporting, and how are we able to assess those companies, and basically make a fair assumption for a portfolio at large. So if you can just kind of touch on that piece, I think that would be helpful.
Yeah, it's interesting. Like as Andy was saying, you don't necessarily know what the company's reporting. They're not always held to a legal standard for some of this stuff. And so we'll see some interesting outliers that are like tremendously low for what the company's size is. And sometimes we'll look at another indicator that they've reported. So maybe it's like hazardous waste and then it's injury rates for a mining company or something like that. And we see, okay, this is a holding company. So they're a royalty company. They have stakes in a bunch of different mines. And they're reporting an injury rate that looks quite high, but a hazardous waste rate that looks quite low. We know they're in this industry. They're probably not reporting operational hazardous waste. And this is something that the estimation model does at scale, is give us an idea of its magnitudes larger than this. And we'll go through and talk with the data providers and submit reports and essentially like quarantine that data variable. And so we think it's really important not to use this stuff without having that baseline assurance.
Yep, that's super helpful. Great. So maybe one piece we could speak to, I feel like that's an example of how we've been able to kind of improve data qualities and how we're incorporating data into sustainability models and assessments over time. Similar to how we've seen more regulation around, fund naming and marketing to combat greenwashing. Maybe we can quickly touch on some of the progress that we've seen in the US around standardization and requirements of sustainability reporting. Over the last several years or so, as we're seeing more and more and better data available to us.
Do you want to take this? I'll just start off with, well, the SEC climate disclosure rule is probably central to this conversation. That was a rule that essentially was the most fundamental reason that the SEC was created. I mean, it was created in 1934 because trust had broken down between companies and their beneficial owners. And so they created financial audits, standardized, audited by a third party or verified by a third party in standardized formats for comparability. 90 years later, we are saying that there are other things to consider than just the finances. These are called they're material. It's information that you need to make a buy or sell decision. That's the definition by the Supreme Court. And that decision is from the shareholder. The investor gets to decide what is material and what is not. So the climate disclosure rule basically said, companies, if you're going to put out information, it's got to be accurate, verified by a third party in a standardized format. It's very fundamental. It's a materiality audit. There's a lot of different things that one could use to make a buy, sell, or hold decision to optimize for outperformance. I mean, one example, as you saw, we did a report last year where we looked at the workforce diversity of 1,600 companies over 5 years. And what we found was a statistically significant correlation. Greater diversity led to financial outperformance in 8 key metrics. So, of course, people want to overweight their portfolio toward companies with a more diverse management team because they're going to make more money. But what happened when so you want these data to be accurate. What happened when the climate rule came out, it was still had that fundamentals, but it said that the companies get to decide what is material or not, that's a fundamental problem. It also, not to get too deep into the weeds, but it said the companies didn't have to disclose scope 3 emissions, which are about where 80% of the emissions are. So on the one hand, it kind of neutered it, but on the other hand, at least there's a structure, a framework that's for a materiality audit. So I think it's a move in the right direction. But what's really going to be happening is, because Europe is implementing, CSRD, and 49,000 European companies and 10,000 US companies are going to have to now be disclosing under those rules, which are a little bit more stringent, I think you're going to be seeing the whole trend is toward just greater, more accurate disclosure.
Yeah, I honestly don't have much to add there. We noted the same thing in our letter to the SEC. Is the scope 3 was is not even that difficult for most of these companies, and there's only a few subsets that they really need to monitor, and it's also just essential for people to get a real picture of where their operations are, honestly. Yeah, I think one of the things that is also exciting to us is not just on the company side, but on the amount of other data that's coming to life. You know, we have a lot better picture of methane from satellites, of where these rogue emissions are coming from. Nature data has started to come online and be really interesting. And so there's a lot of other ways you can bring these things to bear and kind of correlate them and determine where the company disclosures are really needed, or where you might want to put more emphasis or skepticism on them.
Yeah. And then one other question that we did receive from an audience member relatedly is this idea of the impact of qualitative data in addition to quantitative data. So Kellen, maybe that's one that you can speak to, just kind of the difference between those two definitions and why we think that qualitative data is equally important and additive to how we're assessing companies.
Yeah, absolutely. I think it's like similar to the other stuff we've been talking about, where these are very broad categories, right? There's not, it's kind of silly to always prefer quantitative data. It definitely has its use cases. And as far as like putting forward specific impact calculations or thinking through maybe some specificity or measurability. But, you know, some of the stuff Andy was talking about on like involvement with prison supply chain or involvement with private prisons, like these are very important variables that allow you to pull on the string a little bit. And I think just generally, it's very important to not think about impact as only being from the quantitative involvement, or things that you can absolutely explicitly measure down to the last iota. I think it's really important to think about. We know that certain things like divestment are extremely important. We know that they work, especially in less liquid markets or with a fixed income focus or at the corporate level. Can we specify exactly how much this new investment is adding in to the cost of capital for companies that may be more extractive or that are maybe have the worst practices? Maybe not necessarily. We know there's a threshold there. I think there's times to understand that, yeah, you can have this kind of false precision. And it's really about the purpose of what you're trying to do.
Yeah, makes a lot of sense. Okay, great. Well, I think we can transition on to the third myth that we wanted to tackle here today. Kellen, you kind of just touched on this, but the idea that there are many ways to have impact, right? So engagement, research, philanthropy, divestment, direct investment. One of the myths that we wanted to tackle was this idea that having impact can be sufficiently accomplished through private markets and or philanthropy. So essentially, we don't need to worry about this as it relates to our investments or worrying about the divestment movement. We're good to go if we're just thinking about impact through, again, private investments and philanthropy. This is something that I have seen quite a bit working with a lot of our institutional clients. So mission-driven organizations like foundations, where they're doing a lot of really great work in terms of their initiatives, their programs, their charitable donations. But we've oftentimes found that there's quite the disconnect between the causes that they're focusing on directly and their investments. And a lot of times that misalignment can be really shocking to the group that has, put so much work into focusing on these causes that are so important to them. So maybe we can quickly touch on why we think that divestment is such an important piece of this puzzle, and that it is really just another way to maximize your impact, in addition to all the other great work that folks are doing.
Yeah, I thought it was very well said. We talk to folks and they have, maybe they have situations like they're mostly focused on, as you said, maybe they're philanthropic giving or private markets interventions, which is great. But a lot of times they're not really looking at the public market portfolio. And so even though, they have these really compelling stories about some of the work that they're doing, the giving that they're doing around, say, tobacco or like health or something like that, they have all these companies in their portfolio that are at the same time, producing these things or heavily involved. And so the impact that you can have is definitely perhaps potentially offset if you're not looking across your entire portfolio or thinking about all the different implications there. And I think that gets into some of this maybe myth around divestment and the role that it plays. Even though you can't see maybe, when you trade a change at the company level, it doesn't mean it's not happening, doesn't mean it's not necessarily building, or there's not pressure applied or other routes that you can do to increasingly lever what you've done there. So we've definitely seen some real light bulbs go on with folks when we've showcased what's in their portfolio, and then they weren't even aware, similar to what we were talking about before.
Yeah.
I'm going to push back a little bit because, well, two things. One, As You Sow is funded by foundation grants. So we love philanthropy and we think people should be doing more philanthropy, and that it's a great way to have impact. So let me just put that out there. And the other thing is, in terms of coherence, if you do have companies in your portfolio that are doing the opposite of your mission, if you know how you're voting your proxies, if you're using your power as a shareholder, either through engagement, working with As You Sow as part of the engagement, but certainly voting. And this is where the big disconnect happens. We find that, I mentioned there's, 100 million people with $10 trillion who don't even know what's in their portfolio. They don't realize that they are owning big oil and private prisons and all this stuff. But they've also handed off their proxy vote to asset managers that are voting 98% of the time with management. Now, if you own companies directly, if you have a separately managed account, and you have companies in there that are doing the opposite of your mission, well, when you vote, that is how, remember, the board of directors reports to you. And if you don't use your vote well, then you are simply not using your power. 20% of every vote at every annual meeting, people simply throw away their mail-in ballots. I mean, these are just individuals who have shares, and they get a ballot in their inbox, and they open it up and they go, oh, I don't know how to vote these directors, and what's an auditor, and what are all these resolutions?
Yeah.
There's a very easy way to do it. We have a program called As You Vote. If you like our policy, literally one click, you can set it, you can forget it, and you will vote the As You Vote policy on every single item on every single ballot that you own. So remember, you have so much power. I mean, I tell this to people all the time. People abdicate their power without knowing they even have power. And I call it captured capitalism, because we think we have capitalism, but not when you've got all the voting power aggregated with just a few companies that are simply supporting the status quo. Again, how do you change to have a livable planet with justice? You got to use your power. And so when you divest, you no longer have those votes. And I understand there are certain instances where, if you can't sleep at night because you own this company, you shouldn't be owning it. The divestment movement with fossil fuels is very effective because it went to scale with $40 trillion worth of assets, saying that they were going to remove fossil fuels from their portfolios. And so it can be very effective, but engagement can also be really effective.
Yeah, I don't know that we're really disagreeing, but I think it's for us, I think, or at least for me, it's a total portfolio thing, right? And I don't think your philanthropic giving, which is extremely important and funds a lot of foundational work, and as Andy was saying, nonprofits, isn't necessarily separate always, or at least should be thought about in similar ways to the other work you're doing in public markets, which of course means divestment and it means engagement. And I think, Andy, your point is really good about the importance of combining these two, right? Like, if there is a company that you can engage with, realistically, your shareholder proposal isn't going to matter to some of these companies. It's off the scope of what they can even accomplish, or the board is going to shift if their entire operational model is devoted to something that is completely unsustainable, and they're going to be totally intransigent about it. Then that's the time you divest. And sometimes there's ways you can use them together, and you can engage and then divest. And anyways, a bunch of interesting stuff we're working on with this. But I definitely agree with that. And I think the power of, as you said, the power of the vote is extremely important. And I think understanding what's in your portfolio and holding the companies accountable, for sure.
Yeah, or you escalate. You also remember the board reports to you. If enough shareholders feel like the company is going down a path that is not a good, has long-term sustainable growth, then your board of directors is not doing their job. And so the board of directors needs to be replaced. So there, you can also escalate. And I think that it's a very individual choice. Like, how do you want to do it? But just being aware of what's in your portfolio is where you start, and making sure that it matches your, you know, your values, and also your, you know, where you want it to go. So there's a lot of ways to play this.
Yep. I think one piece of that we oftentimes do with our nonprofit clients is we'll actually review their charitable giving, and we can use that as a starting point to help them think about how they could further align their investments. So we'll use that actually as a framework for some of that sustainability decision making and some of that sustainability lens that we're actually applying to their portfolio, which can be a super impactful process and exercise to go through with a multi-stakeholder organization.
Mhm.
So that's something that we've been really kind of enjoying doing more so with our clients as of late.
Yep. What's interesting is, you know, we've been talking to a lot of university endowments lately, and many of them, almost all of them, have some sustainability goals. They have a philosophy that they've laid out, that they've applied to their operations. They're, you know, they're putting solar on the dormitories. They're, you know, they're getting LEED buildings. They're applying it to their, the food that they serve and all that stuff. But they almost never apply it to their 403B plan, their retirement plan for all their professors and administrators. Generally, it's the opposite. They are invested, they almost have the same 401k plan as Exxon has. Okay. And we point this out. We said, look, you're doing all this great work and you have this, you know, this sustainability goals, but everybody who works here has Exxon's 401k plan, and you're handing all your votes off to Vanguard that's voting 98% of the time with management. And they go, oh, we can't fix it. It's really, really hard. And it's actually really, really simple. It's literally 2 DocuSigns away from having a fully sustainable 403B plan, proxy voting aligned with your values, and guess what? You're going to make more money. I mean, I can tell you, as you sow, we've shifted our entire 401k plan. We not only saved money on fees, but also the target date fund that we have is outperforming what we used to have with one of these bigger asset managers. So everybody's happy, and it's aligned, and you have this coherence. There's a real cognitive dissonance that's happening, and I think it shows a culture that respects the agency of your employees when you give them choices. And I'm not saying everybody's the same, but you know, you can offer Vanguard, and you can offer sustainable target date funds in the same plan, and people can choose. It's like, just respect people, give them a choice, and you'll be amazed at what happens. Because I mean, we're seeing about 72% of people, and when we were doing polling, want to actually invest in a livable planet, want to have sustainable investments, and also want to outperform the market. So you can do all that.
Yep. Maybe that's a good segue, I think, to the 4th myth that we wanted to tackle as much as we can without giving our compliance team a heart attack. I think we should touch on the 4th myth, which is that incorporating sustainability means sacrificing on performance. Perhaps one of the most prevalent myths I feel like I have encountered over the last, few years or so. So I think we should make sure that we touch on this one. Before we jump into that, though, Sorel, I did want to check with you if there are any questions that we've received from the audience so far. I did just see one pop in. Great. This is a question from Keith that maybe we'll table until the end. I do want to touch on these last 2 myths that we have, but Keith is wondering, how can asset owners promote diversity within the investment industry? So great. Looks like we can see the questions coming in. And Keith, thank you for that. We'll table that one, but I think first let's just quickly touch on the performance myth. I'll hand it over to Andy and Kellen to touch on this one.
Why don't you go first, Kellen?
I was going to say, for us, I think it's really important to think about what the goals are for the strategy potentially. I mean, there's a lot of different ways you can think about risk and performance and everything like that. And what do you really want to incorporate and accomplish with your sustainability? So, what do you really want in there? Is it pure financial materiality in a short-term basis around things like poor corporate governance or regulatory risk? Is it ability to see what's called like double materiality and things that are thinking about sustainability and how the company actually affects its environment and community? There's a lot of different ways you can layer that in. And so I don't think it's productive necessarily to think of sustainability strategies as one thing. So when you say ESG, it's a bunch of different things. It could be a very focused thematic again, and it could be something that's looking mainly at corporate governance or thinking about some specific lens that the investor has. And there's a lot of different ways to configure that may lead to greater or lesser risk, or what you might think of as like tracking error from a benchmark. So again, I think there's a little bit of like an ill-defined element to that question, that this sustainability is just one thing, and that performance goals usually mean one thing. It's like as Andy said before, to me at least, it's just investing. It's just thinking about what your goals are, how you're going to configure it. And then I think also like on the studies, there's not evidence that supports this broad claim that this sacrifices performance.
Yeah, I would agree. I think that from what I've seen and from all the studies that we've seen, by the way, we aggregate a lot of this this information. We have a website called investingesg.org, and our slogan is, of course, that you can't spell investing without the letters E, S, and G. But we basically aggregate a lot of studies and a lot of interviews with CEOs and all that stuff. I'm talking about how they're meeting their sustainability goals. Kind of bottom line, if you go to investyourvalues.org, you can literally call up an index and the index without oil, and you can look at the 10-year returns, 5-year returns, 7-year returns, whatever. You can see exactly how they're scoring in terms of their sustainability, but also their returns. You can sort all the mutual funds in our system, 6,000, by returns, 3-year returns, 5-year returns, 7-year returns. We think it's incredibly important to use that. When As You Sow was designing our 401k plan, we chose a sustainable target date fund that outperformed both Vanguard, BlackRock, TIA, and Fidelity. And it happened to get better grades also, but it outperformed over 7 years. So you can make choices, and that's not to say every sustainable ETF or mutual fund is going to outperform. It's not to say every responsible, responsible investing is not going to always outperform irresponsible investing, and irresponsible investing is not going to always outperform. You got to do your homework, and there are good managers, there are bad managers, and there's mediocre managers. So you got to look at it, do your homework, and that's but there's certainly plenty of products out there. I can tell you, when we started fossil-free funds in 2015, there were literally, I don't know, there were like 20 funds that we could consider fossil-free. And now I've lost track. There's literally like just hundreds and hundreds of them. And so there's a market for it. People want it. Some of them outperform and some of them underperform. Again, which benchmark are you looking at? So there's ways to do your homework. And so pick ones that match your values and also your performance metrics.
Right. Sounds like it's very hard to generalize, across use cases, but it's something that we should tackle, one off, to your point.
Well, all the aggregated studies, like the meta studies have all said there is no trade-off. Like there's good, bad, and otherwise, and there's just no one thing that you can say about performance.
Right. Great. So maybe we'll drive forward here to the fifth and final myth that we wanted to touch on today, which is this idea that sustainable investing is only for certain political affiliations. So I think one thing that we've gotten kind of questions on from people in general is what matters most to clients when it comes to sustainable investing solutions, and how can we kind of really speak to all parties, all political affiliations, find common ground when it comes to these things. So this is the last one that we wanted to touch on with the group here today.
I think anybody who breathes and who eats, who uses water, probably would want to be investing in a livable planet. So that's a pretty broad group of people. And I kind of leave it like that. It's you
Yeah.
know, if you're particularly if you're investing for your retirement, you want to be, look, we're in a major shift right now. We're
Yeah.
shifting away from an extractive economy, from the ideas of Milton Friedman that you can externalize your costs, that was a good thing to dump in the commons. Those ideas of the 1970s are simply have been shown to be a failure. And we are now shifting toward a Joseph Stiglitz, who's another economist, model. He just wrote a new book called The Road to Freedom, where he overturns the myths of these whole Milton Friedman economic structure and shows another whole way to do capitalism that actually can benefit all of humanity, as opposed to just a few oligarchs. And we are in the throes of that. In 2019, the Business Roundtable agreed to a new purpose of a corporation. 181 companies, Exxon and JP Morgan, all of them said, Milton Friedman didn't work. So now we're going to go with this whole idea of stakeholder capitalism. You take care of your employees, your communities where you operate, your customers, your supply chain, and you will have greater returns. And so that's why it feels so chaotic right now. But I believe that there is an absolute glide path into that, what we call a regenerative economy, one that is based on justice and sustainability. So I want to invest in that. I want to invest in something that's got long term. I don't want to invest in an industry that's going to be winding down in a couple of years. So those are the choices that you make.
Yeah, I love that. And I think a lot of times we'll say sustainability doesn't belong to just one party. You know what I mean? It's not one person's thing. As I agree with what Andy was saying, is if I would say almost everyone, we've never met someone that isn't interested in clean water or, human dignity, some of these other larger issues. I think where I don't know, disinformation is quite damaging is in this cloud of, I don't know, perception or something. When you bring people in, and what we've spent a lot of time on is building a data framework and an evidence framework to say, if you care about this, these are the things that are driving it. We've done all this research. Come read what we've got and come have the conversation. And we've seen some interesting changes in perception on that. When you really connect with what people care about, you can start to challenge things or start to say, hey, this is what we see. You know what I mean? These companies are doing this. Is this something you want in the portfolio? And it's like, these risks are really important, right? And I think that's what people are being robbed of, or not having the ability to see some of these costs. And we've seen this with, some of the states that have removed some managers with ESG considerations out there, and all of a sudden their muni bond costs go up even because they're not getting the choice for in these when the bond auctions go off and everything. Anyway, and that's played out at a larger scale, but also the smaller scale with individual investors that aren't seeing the risks that are affecting them. I think it's really important that we push back on that with evidence.
Right, but there's a propaganda war going on. I mean, look, Leonard Leo was given $1.6 billion in 2022 to try to stop this shift, to try to stop the invisible hand of the markets. I mean, they call themselves conservatives, but they are using like the heavy hand, the ham-fisted big government to try to stop the invisible hand of the market. And, he spent $200 million a year over 3 years on a massive communications campaign to try to get people to think that there was, this whole campaign of that the S in ESG stood for Satan. I mean, people believe this. I mean, I've talked to people who actually believe that there's some sort of satanic cult going on. This is the best they've got to try to overturn. I mean, people call it a movement. I don't. I call it a crusade. It's about 20 people who are just, at the behest of the oil companies, trying to get people to not assess risk, as opposed to millions and millions of people who actually want to invest in a sustainable and just future. And so you got to really take it for what it is, which is a propaganda campaign that is being, set up by the status quo because they do not want to lose power. I mean, in 2020, 82% of all board seats were held by white men. In 2024, it dropped to 77%. Leonard Leo came out and said, that is unacceptable. We have lost too much power. We only have 77%. And there's a brilliant campaign. I thought it was one of the best and it's called So Many Dicks. And what it showed was that there are more men named Richard than there are women on all the boards. I mean, think about that. Like Leonard Leo saying we've lost power, and yet there's more men again named Richard than there are all women on boards. And so the power shift is so on the side of the status quo, but they don't want to lose even one little bit of it. So this is about this transformation, and it's happening. The markets have already decided it. It's done, but they are fighting tooth and nail to try to keep things the way they are. So that is the state of play right now.
Yeah, I think for me, what's interesting is to separate out maybe the industry groups, the pressure campaigns or individuals that have certain agendas from, retail investors that come and may have misinformation or subscribe to certain beliefs, but I feel like you can meet them with empathy and showcase the values and push back. I think it's our responsibility to push back with evidence and to say, hey, these are the real risks, right? Like, what do you think? And it's interesting to see that transformation, or at least to hear folks, what their reaction is to some of this stuff.
Great. Well, in the last few minutes that we have here, I'm seeing some questions come in from the attendees here today. So maybe we can tackle this first one that Ian Woods put in the chat here. In your view, what is the biggest challenge for ESG as a whole? Data, politicization, poor marketing, or something else? Any thoughts on this?
What's interesting about this whole campaign, this, spending $600 million, more people are aware of sustainable investing now than ever. I mean, the silver lining is people are like, oh, I can invest sustainably. Oh yeah, I heard somewhere that it's, some sort of satanic cult, but I didn't know that. And, we find like it's actually woken up people's awareness, woken up people who are, like all their money is in their corporate retirement plan, that there's another option. Wait a minute, I just clicked default and I have no idea what's going on. And now they're starting to ask questions. So I think that all this attention has actually, in the long run, we're going to look back and say that was actually a good thing. That they were protesting too much, that they were protesting so rabidly. And all the stuff at the states, I mean, that's basically going to be overturned. Most of it's illegal. The fact that 18 states that have adopted these laws, 18 pension funds are underperforming the other 32 states. So all the firefighters, all the teachers, all the police officers in those states are going to be wondering, why is it my retirement plan is not keeping up with the rest of the country? They're going to fire these people. They're going to not vote for them. They're going to get voted out of office. So I think this is actually part of this, the transition is the opposition just coming at it so hard that people are going to become aware of it and actually say, oh, that's what I want.
Yeah. I love thinking about it that way. Totally.
Not to say they're not tough to deal with, I gotta say. Just because there's so much inaccuracy, there's so much misleading information, and
Great. We did receive another question from an anonymous attendee to Kellen's point about ESG not being just one thing and how that can confuse the financial performance question. Do we think that the industry would benefit from different terms to describe different approaches with different definitions, or would that be too overwhelming and add to more confusion? So it sounds like the question is really about kind of what we touched on maybe first with the first myth around all of this industry jargon, different nomenclature terms to describe really the idea of more data and better transparency. So maybe we can just kind of jump back to that idea, Kellen, that you mentioned of ESG not being just one thing, and other terms that maybe we could think we've heard more lately, or the direction that we think we could go in to make this a little bit more clear for people.
Yeah, I think it's a great question. I think that I think that some more discussion and maybe regulation, or at least more consolidation around certain terms for how sustainability is managed. There's a lot, actually more variance than I think people people understand typically. And what we see a lot of times is more of a traditional strategy than with kind of a sustainability overlay, or, you know, excluding a few companies at the end of that process. And I think what we think is really important is understanding how central to the development of that, to the asset allocation, to the security selection, the sustainability model is. How complex is it? What data is going in there? How are those preferences balanced? And that's where I think that it's really hard for investors to see what the asset manager is actually doing there. And I think partly that's because we don't have a language for it, and partly I think there's just not enough pressure to really integrate the sustainability into their process.
But there's new labels. I mean, if you look at what the FCA is doing in the UK, they've got 4 labels: sustainability impact, sustainability focus, sustainability mixed goals, and sustainability improvers. The SEC also, in their fund naming rules, they've got certain names. So right now, the regulators are coming up, and the definitions, I got to say, we worked with and consulted with FCA as they were defining these things. They are really, really precise, and they also are auditing on and kicking funds that claim to be one thing out of, like, they're fines for doing it. So I think we're entering this new zone where there will be a great deal of clarity, and then you'll be able to actually have benchmarks. You'll be able to say, how is the performance of this, you know, this fund, of all the funds that are sustainability improvers, and they've also been proven to be that. So the definitions are getting clearer. I think we're at a basically, you know, we're kind of a gawky teenager, and we're maturing. We're becoming an adult as the whole idea of sustainable investing, and I think that's a good thing. So
look, I think Article 8 and Article 9 had some issues. I think I like the UK framework and what you're talking about. I guess what I would like to see is more on the actual process that the manager is going to meet that goal. And I guess I get what you're saying, Andy, of you can look at the actual holdings, you can look at the progress, you can look at the metrics to see how they got there. But I think until you get the transparency into what the managers are actually doing, it's harder to hold them accountable and to showcase that the complexity around the issues are really being represented. But we can talk more about that, yeah.
I think that's the next level is, you know, and I think I think people are going to say, yeah, we want to put, you know, our money into ethics because you guys are doing such a great job with your research and your transparency of how you did the research. People are going to choose you, and they are choosing you. I've seen you guys grow incredibly over the years because of that, because, well, you have you're ethical and transparent. So this is the thing. People are going to choose that because of that.
Well, great. I think on that note, we have a couple minutes left, so I'll wrap and give a quick thank you to everybody who joined today. If there are any questions that you didn't have a chance to ask, feel free to reach out. I'm Claire@ethic.com. Easy to remember. But it was really great to have everybody join here today. And thank you to Andy for joining us so early from the West Coast. It was a lovely discussion, so we really appreciate everyone taking the time.
So, Brady.
Thank you, Claire, Kellen, Andrew, and Claire. It was Claire already. So have a great rest of your day, and thank you for the amazing conversation. Have a good one. Bye-bye, everyone.